Imagine a colossal $2 trillion force lurking in the shadows of the financial world, poised to alter the lives of millions. Could this unseen giant be on the verge of a catastrophic crash? Welcome to the world of private credit, a rapidly growing segment of the financial market that has quietly amassed a staggering $2 trillion in assets. Unlike traditional loans, private credit operates away from the public eye, untethered by the constraints of public markets. According to reports, this market has expanded significantly as companies seek alternatives to bank loans and public offerings. But what exactly is private credit, and why does it matter to you? The rise of private credit is a story of innovation meeting necessity. As banks tightened lending standards post-2008, companies turned to private credit funds for financing. According to data from financial reports, the market's growth has been fueled by institutional investors hunting for higher yields in an era of low interest rates. Key players include large asset managers like Blackstone and Ares Management, who have capitalized on this demand. By 2022, the market had ballooned to $2 trillion, marking a tenfold increase over a decade. But with exponential growth come the inevitable warning signs. Reports have highlighted concerns over the lack of transparency and regulatory oversight in the private credit market. The concentration of risk among a small number of large players and the potential for conflicts of interest are raising eyebrows. According to filings, some deals are structured with terms that might not withstand economic downturns. Are we witnessing the calm before the storm? Close-ups of concerned faces in financial meetings. As the market swells, the cracks are becoming harder to ignore. Data shows an increase in defaults and restructuring among private credit deals, signaling potential distress. Experts warn that a downturn in the economy could trigger a wave of defaults, affecting not just investors, but also the broader financial ecosystem. The interconnectedness of financial markets means the ripple effects could be widespread, impacting employment and even consumer confidence. Footage of abandoned office buildings or factories, graphs showing rising default rates, economic pundits discussing potential implications on news channels. Currently, the private credit market stands at a critical juncture. While it continues to attract investments, the warning signs are prompting a re-evaluation of risks. According to recent financial statements, some firms are already adjusting their strategies, increasing scrutiny of deals, and bolstering their risk management frameworks. Yet, the question remains, is this too little, too late? Busy trading floors with a sense of urgency, interviews with industry insiders providing insights, stock footage of urban landscapes with a focus on everyday people. What can we learn from the unfolding drama of the private credit market? For investors, businesses, and policymakers, the lessons are profound. As the market teeters on the edge, it serves as a stark reminder of the importance of transparency, regulation, and risk management. For everyday individuals, understanding these dynamics could influence decisions on investments, retirement plans, and financial security. Personal stories of individuals affected by financial downturns, graphics highlighting key lessons and takeaways, engaging shots of diverse audiences from young professionals to retirees. As we unravel the intricacies of this $2 trillion question, what do you think lies ahead for the private credit market? Could this be the next financial crisis in the making, or will it find a way to stabilize? Share your thoughts in the comments below, and don't forget to subscribe for more compelling financial stories that impact us all. As we delve deeper into the world of private credit, it's essential to understand the major players driving this colossal market. At the forefront are asset management behemoths like Blackstone, Apollo Global Management, and Ares Management Corporation. These firms have been instrumental in shaping the landscape of private credit. According to financial disclosures, Blackstone alone manages over $230 billion in credit assets, a testament to its significant influence. These companies operate funds that provide direct loans to companies, bypassing traditional banking systems. This method offers flexibility and tailored solutions for businesses, but also introduces complexities and risks that are unique to private credit. The appeal of higher yields has attracted a diverse array of investors, from pension funds to sovereign wealth funds, all eager to capitalize on the returns that private credit promises. Institutional investors play a pivotal role in the growth of the private credit market. With traditional fixed-income investments offering diminishing returns, these investors have been searching for alternative avenues to achieve higher yields. According to a report by Preqin, institutional allocations to private credit have increased significantly, with many funds dedicating up to 15% of their portfolios to this asset class. This influx of capital from institutional investors has provided the liquidity needed for the rapid expansion of the market. However, it also raises questions about the sustainability of such growth. As more capital floods into the market, the competition for deals intensifies, potentially leading to less favorable lending terms and increased risk-taking. The economic impact of the private credit market is profound, influencing not only businesses but also the broader economy. According to data from the Federal Reserve, the rise of private credit has been instrumental in providing financing to mid-sized companies that might otherwise struggle to access capital. This has supported job creation and economic growth in various sectors. However, the challenges are equally significant. The lack of transparency and regulatory oversight means that the true extent of risk exposure is often obscured. A downturn in the economy could exacerbate these risks, leading to a potential credit crunch. This could ripple through the financial system. Regulation, or the lack thereof, is a critical issue in the private credit market. Unlike traditional banking, private credit operates in a largely unregulated environment. This raises concerns about systemic risks. According to reports from the Bank for International Settlements, the opaque nature of private credit transactions makes it difficult to assess the overall health of the market. Regulators are beginning to take notice, with calls for increased scrutiny. There are potential regulatory frameworks to better monitor private credit activities. However, the challenge lies in balancing oversight with the flexibility that has allowed the market to thrive. In response to mounting concerns, the private credit market is adapting. Some firms are enhancing their risk management practices. They are employing sophisticated data analytics to better assess the creditworthiness of borrowers. According to industry insiders, there's a growing emphasis on environmental, social, and governance (ESG) factors. Investors demand more responsible investment practices. Moreover, technology is playing an increasingly vital role. Fintech innovations are streamlining the lending process. These innovations provide greater transparency and improve the efficiency of credit assessments. These technological advancements could be key in mitigating risks. They ensure the market's resilience. Finally, it's crucial to consider the global context of the private credit market. While the United States remains the largest market, private credit is gaining traction worldwide. In Europe and Asia, the market is expanding. This expansion is driven by the same forces of low interest rates and the need for alternative financing solutions. However, each region presents unique challenges and opportunities, with varying regulatory environments and economic conditions. As the market continues to globalize, the interplay between regional markets will be an essential factor in determining the future trajectory of private credit. Will this globalization lead to a more stable market, or will it introduce new complexities that could heighten risks? Understanding the influence of economic cycles on the private credit market is key to grasping its potential vulnerabilities. Historically, credit markets have been highly sensitive to economic downturns. During periods of economic growth, the appetite for risk increases and credit flows more freely. However, during contractions, risk aversion spikes and credit becomes scarce. According to financial data, previous cycles have shown that private credit markets can experience heightened default rates during economic recessions. The current global economic landscape, marked by geopolitical tensions and fluctuating growth rates, adds another layer of complexity. As interest rates potentially rise to combat inflation, the cost of borrowing could increase, impacting the ability of companies to service their debts. This scenario could lead to a tightening of credit, reminiscent of past financial crises. To truly understand the implications of the private credit market, let's explore some real-world case studies. For instance, consider the case of Toys R Us, which filed for bankruptcy in 2017. While multiple factors contributed to its downfall, a significant element was the burden of debt from leveraged buyouts, a common practice within the private credit sphere. According to court filings, the company's inability to restructure its debt amid declining sales played a critical role in its demise. On the flip side, private credit has also facilitated the growth of companies like Uber and Airbnb, which have accessed significant funding rounds without going public. These examples illustrate the dual-edged nature of private credit. It can be a powerful growth tool or a harbinger of financial distress, depending on how it is managed. Despite the challenges, innovation in the private credit market continues to evolve. New financial instruments and structures are emerging to address the market's inherent risks. For example, collateralized loan obligations, CLOs, have gained popularity as a way to package and sell loans. CLOs distribute risk among multiple investors. According to industry reports, the market for CLOs has reached new heights. This provides a buffer against potential defaults. Furthermore, the rise of blockchain technology offers promising avenues for enhancing transparency and efficiency. Smart contracts and decentralized finance, DeFi platforms, could revolutionize how loans are issued and managed. This reduces the reliance on traditional intermediaries and increases trust among participants. At the heart of the private credit market are the people whose lives and livelihoods are intertwined with its fate. From entrepreneurs seeking capital to expand their businesses, to workers in industries reliant on credit-fueled growth. The ripple effects of this market are far-reaching. According to labor market studies, sectors heavily dependent on private credit employ millions worldwide. The social implications of a potential crisis in the private credit market could be profound. Job losses, reduced consumer spending, and economic uncertainty could affect households across the globe. It's a stark reminder of the interconnectedness of financial systems. The importance of sound economic stewardship cannot be overstated. As we conclude our exploration of the $2 trillion private credit bubble, responsibility and awareness are paramount. For investors, understanding the nuances of the private credit market is crucial to making informed decisions. For policymakers, crafting regulations that balance growth with risk management is essential. This is crucial to safeguarding economic stability. Education and transparency are vital tools in ensuring that the private credit market evolves in a manner that benefits all stakeholders. By fostering a culture of accountability and informed participation, the market can continue to thrive without succumbing to the pitfalls of unchecked growth. Educational seminars and workshops on financial literacy, panels of experts discussing strategies for responsible investing, engaging public service announcements on market awareness. As we stand at the crossroads of potential crisis and opportunity, the private credit market remains a testament to the power and peril of financial innovation. It's a world where fortunes can be made and lost, where the stakes are high and the outcomes uncertain. The future of this $2 trillion behemoth hinges on the choices made today by investors, companies, and regulators alike. And so, we leave you with a question. In the world of finance, where do you see the line between innovation and risk?